Deep Dive Podcast by the Boca Raton Tribune.
Imagine being offered, well, a true shortcut to financial freedom, like a golden ticket to Warren Buffett's legendary stock picks.
Yeah.
And it promises these eye-watering 500% returns with virtually no risk. Sounds almost like something straight out of a dream, doesn't it?
Yeah.
But what happens when that promise, that really enticing promise backed by, the most prestigious credentials, isn't just a fantasy? What if it's actually a calculated deception?
It's such a classic setup, isn't it? That siren song of easy money, especially when it's sung by someone who, on the surface, seems to embody trust, intelligence, elite access. It can be incredibly persuasive, often overrides even well-honed skepticism. It just draws people in, sometimes despite obvious red flags.
And that's exactly what we're plunging into today. Our mission on this deep dive is to really unpack the intricate details of a recent federal indictment. It shines a frankly stark light on an alleged multi-million-dollar Ponzi scheme. It's a complex fraud and allegedly orchestrated by a Harvard Business School graduate. And it's just a profound reminder, I think, of how easily even sophisticated investors can get ensnared. Most importantly, we're here to distill the key lessons for you, our listener, on how to spot these kinds of traps and, well, protect your financial future.
Yeah, this case offers a really fascinating, though obviously sobering look at the psychology of fraud. It highlights how quickly perception can just diverge from reality, especially when the perceived authority of the individual is sky high. We'll delve into not just what happened, but maybe why these schemes can be so tragically effective.
Okay, so our core story revolves around Vladimir Artamonov. He's 46 years old. And according to federal prosecutors down in Manhattan, he was the mastermind behind this pretty elaborate scheme, the central accusation. Allegedly defrauding investors, and this includes some of his own former classmates, fellow alumni from a top-tier institution, out of over $4 million. And all of this hinged on a completely fabricated investment strategy, supposedly tied to, of all people, Warren Buffett and Berkshire Hathaway. Okay, let's peel back the layers on this one.
Well, what's immediately striking here is the sheer credibility Artamonov was apparently able to leverage. I mean, being a Harvard Business School graduate isn't just a line on a resume. It's a powerful signal, right? It implies rigorous intellect, a certain level of professional skill, and often, entry into these elite networks where trust is often just an unspoken currency. This credential, just on its own, it acts as a profound trust accelerator.
Absolutely. And the source material really emphasizes that he allegedly specifically targeted and lured investors from his own network. Former classmates, fellow alumni. This isn't just any pool of investors. These are people who share a significant formative life experience, maybe mutual friends, professional connections, even a shared sense of identity from that very institution. Can you elaborate a bit on why an alumni network, which you'd think would be kind of a safe space, can become such fertile ground for this kind of alleged betrayal?
It's a critical vulnerability. Within these close-knit, educated communities, like an alumni network, there's this inherent level of social proof, implicit trust. The assumption often becomes, they're one of us, they wouldn't deceive us. This is what we sometimes call the halo effect in action, where the positive glow of that Harvard degree and that shared institutional bond just made his investment pitches seem inherently more legitimate. People often assume competence and integrity in one area, like getting the degree, translate to all others. And this creates a fertile environment for bad actors, because that natural skepticism, which is so crucial in finance, it often gets dampened by personal connection and shared prestige.
And then there was the irresistible promise itself. The core of his alleged fraud, according to prosecutors, was telling investors he possessed this uncanny, almost prophetic ability to predict precisely which stocks Warren Buffett's Berkshire Hathaway would buy next. I mean, for any investor, whether you're an amateur or seasoned, that kind of insight just sounds like the ultimate advantage.
It's a brilliant hook, almost irresistible, really. Warren Buffett's name is synonymous with not just incredible financial success, but also with integrity, right? A deep understanding of value, a long-term, low-risk approach. So, tying a strategy to his name immediately lends it this aura of, unparalleled reliability, a proven track record. Artamonov's alleged method was dubbed Project Information Arbitrage. He claimed he could identify these upcoming stock moves by meticulously reviewing regulatory filings from Berkshire Hathaway's various insurance units.
Okay, now, for a listener who understands the market, that phrase Project Information Arbitrage and reviewing regulatory filings, that might even sound plausible.
Right.
Because legitimate investors do analyze filings. So what made his version so insidious and ultimately just a lie?
That's exactly it. For an informed investor, the idea of legitimate arbitrage or, deep diving into filings like 13Fs, which disclose institutional holdings, that's a real thing. What made Artamonov's alleged strategy a fabrication was his impossible twist, claiming airtight insight that enabled him to front-run the market and generate 500% or more with little risk. Those last few words, 500% or more with little risk, I mean, that's the ultimate red flag. It just flies in the face of every fundamental principle of financial markets.
Right, that's the part that truly stands out. When Artamonov spoke of 500% or more with little risk, what's the immediate signal that just screams fraud to someone with your expertise? How would you advise listeners, people listening right now, to react to such an outrageous claim, even if it comes from someone with seemingly impeccable credentials?
Those numbers, especially coupled with little risk, are the quintessential hallmark of a fraudulent scheme, period. Real sustainable investment strategies simply do not offer such astronomical returns with minimal risk. It doesn't exist. In finance, risk and return are, they're inextricably linked. If you're promising immense returns, the risk involved should be equally immense. It's almost a law of the market. The very notion of airtight insight into the moves of an investor like Warren Buffett, allowing for risk-free market front-running, it should trigger immediate, intense skepticism. My advice. When something sounds too good to be true, it almost certainly is. Walk away, then run. It's almost like the villain in a movie openly telling you their evil plan. It's that obvious if you know what you're looking for.
Okay, so that was the irresistible dream he sold. But what did investigators uncover about the grim reality behind Project Information Arbitrage once they started digging?
Well, the truth behind it was, as is often the case in these deceptions, a complete fabrication. Prosecutors alleged that instead of executing this, supposedly sophisticated strategy, Artamonov actually used investor funds to buy highly speculative, really risky short-term options. And these had absolutely no connection to Berkshire Hathaway's actual investment philosophy or holdings. None. He was essentially gambling with other people's money, betting on volatile, quick market movements rather than doing anything resembling arbitrage.
And this is where the classic Ponzi scheme structure comes into play, creating that terrifying illusion, right? When those early investors naturally started asking for their money back after seeing those promised incredible returns, Artamonov allegedly didn't have any actual profits to give them, so instead he just repaid them by taking the capital from newer investors.
Precisely. It's a horrifyingly simple but brutally effective mechanism. The Ponzi structure is designed to create an illusion of profitability and liquidity. Early investors get paid returns using funds from later investors, which makes the scheme look successful, right?
Yeah.
And that encourages more people to invest or existing investors to roll over their supposed gains. This keeps the existing investors happy for a while, making them powerful, unwitting recruiters for the fraud. But it's just an unsustainable house of cards, a cruel shell game where new money must constantly flow in to pay off previous investors. The moment that inflow slows, the whole thing collapses, inevitably leaving the last people in with absolutely nothing. In this specific case, prosecutors allege Artamonov misappropriated over $4 million, and a significant chunk of those funds weren't even going into these risky options. They were reportedly used for his personal expenses, funding a lavish lifestyle, not legitimate investments.
Wow. Over $4 million gone, some of it just funding his lifestyle. That's truly a staggering amount. It represents countless individual dreams, savings, just wiped out. When you see a case with such widespread financial and, frankly, personal betrayal, what are the most severe legal ramifications someone like Artamonov typically faces under federal law?
Oh, he's facing very severe federal charges. The indictment details specific counts, including securities fraud, wire fraud, and investment advisor fraud. To maybe break those down quickly for our listeners, securities fraud covers deceiving investors about their investments. Wire fraud applies because he allegedly used electronic communications, phones, internet, email, often across state lines, to carry out the scheme. And investment advisor fraud speaks to falsely presenting himself and his strategies while acting, in an advisory role. These charges together really reflect the gravity of not just stealing money, but systematically eroding trust through calculated deception and misrepresentation. And each charge carries potentially substantial prison sentences and, of course, heavy financial penalties.
And the official condemnation from the authorities is pretty strong, too. U.S. Attorney Jay Clayton, in a statement, didn't mince words at all. He stated that Artamonov betrayed investors, including friends and former Ivy League classmates, by promising a low-risk, high-return investment strategy when, in fact, he gambled away investor money, unquote. That quote really drives home the profound personal nature of the violation, doesn't it?
It's a powerful statement. It really highlights the dual nature of this crime. It wasn't just financial deception, it was a profound violation of trust within a community where trust is, well, typically assumed. It underscores the predatory aspect of targeting individuals with whom you share a personal or professional history, twisting those connections into tools for fraud. And what's maybe even more troubling, and a critical detail for our deep dive here, is that this wasn't some isolated incident that just popped up. This federal indictment actually follows a previous action by New York's Attorney General back in February 2024, an attempt to block this very alleged fraud.
So this suggests a pattern, right? Not just a one-off mistake or lapse in judgment. The warning signs were there, and authorities were already tracking alleged illicit activity, even if the full scope wasn't immediately clear. That adds another layer of gravity, I think, showing the persistence of the alleged deception.
Absolutely. It indicates a sustained, deliberate pattern of behavior, which definitely deepens the severity of the charges. It also reminds us how challenging it can be for authorities to fully unravel and halt these complex financial schemes, even when they're aware of potential issues. Fraudsters, especially those with an appearance of credibility, can be incredibly adept at, moving their operations or adapting their narrative to evade detection for a while.
And just to be absolutely crystal clear for you, our listener, the source explicitly states that Berkshire Hathaway and Mr. Buffett themselves have not been accused of any wrongdoing whatsoever in connection with this scheme. It's crucial to understand that they are entirely separate from Artamonov's alleged actions. Their esteemed names were simply exploited as a deceptive tool.
That clarification is vital. Yeah. It's easy for the public sometimes to conflate a fraudulent scheme that uses a famous name or institution with the entity itself. In this instance, Warren Buffett's impeccable reputation was merely a prop for deception, not an accomplice. The scheme really highlights how even the most respected brands or names can be misused to lend false legitimacy to a con.
And ultimately, this isn't just a story about fraud. It's a critical learning moment for all of us, I think. This entire saga, from the Harvard credentials to leveraging the Buffett name to that 500% with little risk promise. It's almost a masterclass in how an aura of expertise and an irresistible yet ultimately false opportunity can be exploited. It just underlines why critical thinking isn't just some academic exercise. It's a necessary defense mechanism when you're faced with promises of outsized returns that just defy logic.
Absolutely. The broader implication here is that credentials, while obviously important indicators of achievement, hard work, they should never be a substitute for independent verification and a healthy dose of skepticism. This case perfectly showcases how that halo effect can blind us to really obvious red flags. We have to challenge even the most prestigious backgrounds with rigorous, independent due diligence. The financial world is, yes, rife with legitimate opportunities, but it's also teeming with those who seek to profit from others' desire for wealth, often by appealing to their sense of trust and perceived authority or, supposed insider knowledge. It's a fundamental principle. If you're not doing your own homework, your own research, you're really setting yourself up for potential disappointment or worse.
So this deep dive into Vladimir Artamonov's alleged scheme offers a stark, but I think incredibly important lesson. The core takeaway, one we really can't stress enough, is the crucial importance of skepticism. You need it even when you're presented with individuals who seem highly credible, even when the strategies sound foolproof, and especially when the promises of returns are unrealistic. Don't let perceived authority override your gut instinct when the numbers just don't add up.
That phrase, low risk, high return, it should almost always sound an alarm bell in your mind. In fact, it should be screaming at you. It's almost never an opportunity. It's a classic warning sign. Understanding the fundamental principles of investing where risk and reward are inextricably linked, that is your absolute best defense against these kinds of deceptions. Always ask for clear, verifiable documentation. Scrutinize regulatory registrations, and if something sounds like a secret shortcut, it's almost certainly a dead end.
Right. This case really reminds us that even with impeccable credentials and that siren song of too good to be true, persuasion can be incredibly powerful, especially when it taps into our deepest hopes for financial security. So, in a world awash with information and financial opportunities, here's something to think about. How do you critically evaluate the claims made by those in positions of apparent authority, especially when extraordinary financial gains are promised? And what specific steps do you take to protect yourself? We encourage you to maybe ponder those questions, perhaps even make a little checklist for your own investment vigilance going forward.